Chapter 6, Industry Analysis. Learning Objectives. After studying this chapter, you should know about role of industry analysis in fundamental analysis, challenges in defining an industry, industry cyclicality, market sizing and trend analysis, secular trends, value migration and business life cycle, various industry analysis framework such as Porter's 5-force model, PESEL analysis, BCG analysis and SCP analysis, key industry-specific drives and industry KPIs, regulatory framework including taxation, role of industry analysis in fundamental analysis. Economic analysis helps us understand whether business, in general, is likely to grow in the foreseeable future or decline. Industry analysis helps in understanding how each industry would be impacted under the current economic conditions. In industry analysis, analysts also try to understand how the various players in the market industry are likely to react and how that may affect the prospect of the industry. The various questions that have to be addressed in industry analysis include the following. 1. What is the industry in which the company operates? 2. How much does it get impacted on account of cyclical trends in the economy? 3. What is the potential industry size? 4. How has the industry been performing in the past and what were the drivers behind the performance? 5. What is the level of competition in the industry? How does it affect the pricing power of the various players? 6. What are the various secular trends that affect the industry and are they causing any value migration? 7. Are there any regulatory headwinds or tailwinds affecting the industry? Defining the industry. The very first step in an industry analysis is to define the industry in which the company operates. Industry definition is not always an easy task. While there are several standard industry classification systems such as National Industry Classification (NIC) system in India, the Global Industry Classification Standard (GICS), or North American Industry Classification System (NAICS) in US, they may not necessarily capture the substance of the industry. For instance, NIC has a single classification for manufacture of passenger cars. Thus, every car manufacturer including entry-level compact car manufacturers and high-end luxury car manufacturers fall under the same industry classification. However, since the dynamics of the luxury car manufacturer is very different from entry-level passenger car segment, analysts may view them as different industries. The challenge especially increases when a company competes in many industries to earn its income. Let us take the example of PVR Limited. On one hand, PVR Cinemas competes with satellite channels and over-the-top OTT platforms such as Netflix and Hotstar to attract audience. On the other hand, the cinema industry also competes with live theaters, live performances, and sporting leagues. Thus, if an analyst applies a narrow industry definition and classifies the company as part of cinema exhibitors, it creates a risk of overlooking other competitors. But if one were to give broader definition, then challenge is to identify whether to classify the company as part of entertainment media industry or should it be classified as part of out-of-home, entertainment industry. This may force the analyst to classify it as part of a much broader media and entertainment industry. But that would create another challenge as each segment within this broader group have their own idiosyncrasies and not strictly comparable. Camera manufacturing is another example that shows the challenges in defining an industry. A couple of decades ago, cameras were a standalone product. However, with the emergence of mobile phones with built-in cameras, a lot of entry-level digital cameras started losing their sales to these phones. Today, with emergence of high-technology mobile phones, even mid-tier cameras are facing competition from mobile phones. If cameras are defined as a standalone industry, then an analyst may end up ignoring this huge competition from mobile phones. An analyst should carefully consider the various factors that drive the business and should classify it as part of the industry group which have such common driving factors. Thus, if an analyst believes that PVR Limited's business is driven by people's propensity to spend time outside their home, it may be appropriate to classify it as part of out-of-home entertainment industry. On the other hand, if the business is largely driven by people's propensity to consume movie content, then it may be appropriate to classify it as part of entertainment media. GICS, which is widely used in financial sector for global investors, on the other hand, is a four-tiered, hierarchical industry classification system where the four tiers are sectors, industry groups, industries and sub-industries divided into 11 sectors, 25 industry groups, 74 industries, and 163 sub-industries. An example for grouping for energy sector is shown below for illustration purposes. Understanding industry cyclicality. Economic cycles affect all businesses. However, they affect some businesses more than others. Based on the cyclical nature, industries can be classified into 3 categories. Defensive industries. These are industries that create products and services that have low income elasticity, i.e., a fall or rise in income does not affect the demand significantly. Therefore, these industries experience minimal impact on account of economic cycles. Rather, their business prospects are affected only by secular trends. Food, agricultural inputs, and healthcare are some of the industries that have exhibited these traits in the past. Semi-cyclical industries. These industries experience growth in sales during the expansionary phase and decline during recessionary phase. However, these industries do have some base-level demand which help the industry to have reasonably healthy sales in recessionary conditions also. Consumer durables industry has exhibited these traits. Deep cyclical industries. These industries witness extreme cyclicality in their revenues as they are largely driven by economic cycle and/or commodity cycles. Capital goods industry or steel exhibits such behavior. During recessionary conditions, their sales drop significantly as most companies put their capacity expansion plans on hold. However, these industries experience massive growth at the first signs of economic recovery as pent-up demand result in higher orders. Market sizing and trend analysis. Industries that are underpenetrated have high growth potential as there is more headroom for growth. However, as industries mature, the new growth avenues decline and the overall growth rates thus come down. Therefore, while studying industry, it is important to analyze the potential size of the market and current size of the market. However, measuring the current market size is difficult, especially if there are many unorganized players or private companies whose information is not available in public domain. Further, quantifying the potential size of the market also involves making a lot of assumptions which can go wrong. Therefore, studying the past trends can supplement our analysis and help us understand how the industry has been growing and what are the factors that are affecting growth. Such studies also help us understand the underlying secular trends. Market sizing can be done through either top-down approach or bottom-up approach. In a top-down approach, we measure the size of the market or industry starting from macroeconomic factors and arrive up to the industry level. In bottom-up approach, we quantify the market by looking at individual companies and aggregating their data to arrive at the industry size. For example, if we were to quantify the total industry size for a particular therapy, we can use the top-down approach as follows. 1. Identify how many patients underwent the therapy. 2. Ascertain average expenditure per patient. 3. Take the product of 1 and 2 to arrive at the revenue. From a bottom-up perspective, we can look at revenue of all the hospitals that provide this therapy and identify how much or what proportion of their revenue was earned from this particular therapy. We can then aggregate it to arrive at industry size. As mentioned above, market sizing may involve making certain assumptions as all the required information may not be available. Secular trends, value migration, and business life cycle. As discussed earlier, secular trends are long-term trends that cause displacement in production or consumption of goods and services. There are various factors that drive secular trends. 1. Technological advancement. New technology can cause disruption in many ways. It can bring in new methodology in production of goods. It can provide alternative to an existing product or can create new consumption pattern. The following are some of the examples of secular trends caused by technology. A. Horizontal drilling technology enabled exploration of shale gas. This resulted in significant decline in long-term average price of hydrocarbons. B. Digital cameras made film rolls obsolete. Mobile cameras made entry-level digital cameras obsolete. C. Improvement in battery technology is enabling increased use of electric vehicles compared to fossil fuel-driven vehicles. 2. Change in income levels. As an economy grows, the disposable income of population is likely to increase. This can cause change in category of goods and services being consumed. People start consuming premium products compared to cheaper alternatives. 3. Demographic changes. The composition of a country's population in terms of age, gender, and ethnicity may undergo change over a period. This may cause changes in the consumption pattern within the country. For example, aging population in Japan has resulted in decrease in per capita consumption of beer. 4. Change in culture and tastes and preferences. Cultural changes are a constant. Most often, they are gradual. However, sometimes changes can also be sudden, driven by revolution, insurgencies, or a societal response to a pandemic. These changes can cause a change in consumption pattern of goods and services. For example, increasing influence of Western culture in Asian societies created higher demand for Western clothing. 5. Changes in regulation or government policy. Change in regulations or government actions may also create secular trends in industry. For instance, implementation of GST created certain efficiencies in the logistic industry. It in turn reduced the demand for purchase of new commercial vehicles. In addition to the above, many other factors may also serve as a catalyst for a secular trend. When a new secular trend emerges, it causes value migration between industries or between players. And often it also creates an inflection point in the business cycle of one or more affected industries. Value migration. In simple terms, value migration happens when a phenomenon creates long-term advantage for one or more entities at the cost of other entities. Thus, the entity that gains witnesses an increase in its shareholder value while the other entity loses. Such a shift can happen across geographies, across industries, across the value chain, and to a lesser extent between competitors within the industry. Geographic migration. Geographic migration of value happens when a secular trend helps a country or geography as compared to other. For instance, horizontal drilling and shale gas discovery shifted value to U.S.-based oil exploration at the cost of other oil-producing countries, as U.S. had large amount of shale gas reserve and were able to extract them at a lower cost compared to other oil-producing nation. Similarly, globalization helped low-cost manufacturers such as China to rapidly grow its economy as compared to many other high-cost destinations. Cross-industry migration. Cross-industry migration happens when one industry gains at the cost of another. For example, advent of digital cameras resulted in massive decline of film rolls industry and saw big companies like Kodak having to shut down. Migration across value chain. Some phenomenon can result in industries at the down end of value chain gain at the cost of those at the upper end or vice versa. For example, high competition intensity in Indian telecommunications space resulted in significant fall in price of mobile services, which in turn led to significant decline in shareholder value for telecom companies. However, this resulted in increased consumption of digital products and thus more traction for digital content providers. Migration across companies in the same industry. Certain disruption may create new competitive advantage for one company or may remove a competitive advantage enjoyed by an existing player. This may result as value migrating from one company to another. For example, before advent of 2G technology, Research in Motion, BlackBerry enjoyed significant competitive advantage among corporate mobile users. Its mobile devices were the most efficient in accessing emails and other internet services. However, with the advent of 2G technology, many new smartphone manufacturers emerged. They were able to provide similar service. This eventually led to decline in shareholder value for BlackBerry, while its competitors such as Apple saw the value increasing. Understanding and preempting value migration can help analysts identify suitable investment opportunities ahead of time and to exit from the losing businesses. Business life cycle. Business life cycle refers to the various stages through which a business transitions through its journey from its emergence till its eventual decline. Every industry typically goes through the following phases. A. Pioneering stage. The industry is just taking shape. It is not widely adopted. The concept is still being proven or just been proven. B. Growth stage. The concept is found viable and many customers start adopting the new product. As more and more customers adopt the product, the industry witness steep growth. C. Matured stage. The industry has existed for long and most customers who can use the product are already using it. Number of new potential customers are relatively less. D. Declining stage. Change in customer preference or a new technology replaces the industry's product with a new product. At this juncture, the industry starts losing out to the alternatives. E. Reinvention and revival. Although it is very rare, it is possible that the goods or services produced by the industry finds a new use in a different application and starts a new cycle all over again. In the Indian context, call taxis can be looked at one example of an industry that has gone through all the phases over a period. Call taxis in India started taking shape during the end of 20th century and early parts of 21st century. Aided by increased penetration of telephones and growing consumer income, call taxi services witnessed tremendous growth over the next decade. However, with the advent of app-based taxi aggregators, the industry declined significantly in size. Every industry goes through the cycle and in turn causes significant displacement in the economy. The labor force working in one industry will have to kill themselves and move to a new industry or find themselves out of workforce. Similarly, capacity will need to be redirected to a different use. Although secular trends can be traced to business life cycles, there are other disruptors that can affect the secular trend. For example, horizontal drilling technology enabled exploration of shale gas, which brought a long-term decline in crude oil prices without causing any displacement of the goods being consumed. Analyzing and understanding secular trends help the analyst understand the long-term trajectory of the business. However, in order to understand the medium-term and short-term trends, analysts will have to focus on cyclical trends. Understanding the industry landscape. Industry landscaping involves studying all the players in the industry and their interaction with each other. This includes understanding competitors, customers, suppliers, regulators, and emerging technologies. It also involves studying the differentiating factors between various competitors and customers' preference. Such a study will help the analyst understand how the industry may react to external market events. For example, in industries with low competition intensity, companies are likely to be able to transfer any increase in input costs to their customers. Thus, their profit margin is likely to remain intact. On the other hand, if the competition intensity is high, it may create pricing pressure which will likely reduce the profits. Industry landscaping needs to be very comprehensive. While analysts can use their own frameworks, there are certain established frameworks that can help understand the industry landscape. These include the following. 1. Michael Porter's 5-force model. 2. PESEL analysis. 3. BCG matrix. 4. SCP analysis. Michael Porter's 5-force model for industry analysis. Analyzing any industry requires looking at it from various angles and finally reaching to a conclusion about its attractiveness as an investment proposition. Market participants use different methods to make this analysis. Among the many methods used for doing such an analysis is the popular Porter's 5 forces model developed by Dr. Michael Porter in 1979. As the name suggests, this model analyses any industry on the basis of 5 broad parameters or forces. These 5 forces are divided into 2 vertical and 3 horizontal ones as listed below. Horizontal forces. 1. Threat of substitutes. 2. Threat of new entrants. 3. Threat of established rivals. Vertical forces. 1. Bargaining power of suppliers. 2. Bargaining power of customers. Some industries have structure wherein these forces make it very difficult for the businesses to earn significant profits for the owners. For example, either or all or a combination of some of these forces in industries like aviation, telecom, retail, textile, sugar, power, etc. end up keeping profits low for companies in these sectors. Such sectors are termed as unattractive ones by the model from owner's perspective. On the other hand, industries like education, FMCG, healthcare, and IT enjoy huge margins over long periods of time as the forces are not so strong there. Such sectors are termed as attractive by the model for shareholders. 2 of Warren Buffett's quotes in the context of industry structure are pertinent here. 1. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. 2. Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. Mr. Buffett, through these 2 quotes, is clearly indicating that if economics of business is bad, a great management may not be able to bring anything substantial and an investor would be better off shifting his investments to different industry. Now, let us look at each of these 5 forces of Dr. Porter's model in detail. Industry rivalry. An industry where rivalry is high, like the aviation and telecom space, the end result will be lower pricing power and lower incomes for the industry participants. Innovation in products and customer service and engagement initiatives become essential in such an industry. A strong competitor with deep pockets can easily adopt the tactics such as continuously dumping products/services at prices lower than the cost to drive others out of the industry. Not everyone can sustain losses for long period. Intensity of rivalry can be understood from following simple industry characteristics. It would be high if 1. Many companies exist in the business segment. 2. Similar products/services being offered by participants with little or no differentiation. 3. Every industry participant tries to attract customers with similar strategies, lower prices or longer credits. 4. Switching cost for customers from one product/service to another is low or nil. If industry rivalry is strong, businesses in the industry will go through frequent phases of low revenues and profitability. The telecom industry in India is a case to point where a number of players in each telecom circle try to garner market share by offering competitive plans. The high prepaid component in the revenue of all telecom players means that the price-sensitive subscribers would easily migrate to lower-priced offerings of competitors. It is relevant to quote Mr. Charlie Munger, partner at Berkshire Hathaway here, if only basis of competition in an industry is pricing, it is a self-defeating business. So, how can a company in a competition-intensive industry still deliver good returns to its shareholders? Answer lies in aggressive innovation internally as well as externally. Better and efficient operations resulting in lesser working capital requirement, faster turnaround times, lesser cost of capital are some of the things which the company has to do internally. On the external side, launching differentiating products, creating and nurturing strong brands, positioning its products/services uniquely are what the company can do to break out of the clutter. For example, Micromax, a cellular device company in India, managed to garner a 10% market share in just 3 years of launch by focusing on special features at competitive prices. Threat of substitutes. Industries go through significant changes from time to time. Telegram does not exist anymore as short messaging service, SMS, emerged as cheaper and easier alternative with significant accessibility. Cement pipes industry lost its relevance to steel and plastic pipes. Typewriters got substituted by computers totally. iPods, mobiles, etc. have rendered radio and two-in-ones a thing of the past. The most famous example is of the how digital photography completely destroyed the film-based model followed by Kodak. While first digital camera was invented by Kodak engineers, to protect their existing business, the company did not move to that. As innovations happen, existing products become irrelevant. This is called threat of substitutes. The ability of an industry and company to foresee changes and to adapt to them early will define their success. Unfortunately, Kodak did not see the threat and subsequently filed for bankruptcy. Some industries are not able to face the threat of substitutes and fail, while others reinvent themselves to stay relevant. Also, some industries do not have threat of substitutes at all. For example, power, healthcare, education, etc. There could be different modes of servicing customers at different times, but these products/services will never be out of business. Threat of substitutes can be understood from following 2 simple industry characteristics. It would be high if 1. Substitutes offer equal or better experience to customers, quality, price, ease, etc. 2. Switching cost for customers from one product/service to another is low or nil. Sometimes substitutes may take long time to replace the existing businesses. For example, solar products, while are cheaper at operating level, need capex to begin with, and that becomes deterrent for customers. So is the case with LED lights. As technology evolves and new products become cheaper, more and more customers shift to them, posing higher threat to the existence of traditional businesses. Bargaining power of buyers. Buyers can exert a lot of pressure and dictate prices if there are a large number of sellers with similar products/services. On the contrary, they may not be such a big influencer in case there are few sellers for a product/service. In nutshell, it is the function of number of buyers and sellers and differentiation in their products/services which may determine buyers' bargaining power in an industry. The size and profile of the buyer, for example, the government as a buyer of the product or service, can influence the bargaining power they have. Buyers' bargaining power can be understood from following simple industry characteristics. It would be high if 1. Competitive intensity in the industry is strong. Continuous pricing pressure would exist on industry participants. 2. Products/services are standardized with little or no differentiation. 3. Close substitutes of the products/services exist and switching cost for customers is low or nil. Bargaining power of suppliers. A consumer will rarely bargain over the fees charged by hospitals or schools, but the same consumer will bargain with the vegetable or fruits vendor all the time. In the first case, the bargaining power of suppliers is absolute, and in the second case, bargaining power of suppliers is nil until he/she is the only vendor and close substitute is pretty far. The sugar industry, especially in the Indian context, is totally dependent upon the price, which is decided by the government after considering the views of the sugarcane farmers. So, the input cost of the raw material depends upon the price which the suppliers demand. In this case, suppliers have a strong bargaining power. Similarly, supplies of the essential commodity, crude oil, is virtually controlled by a few organizations of the petroleum exporting countries, OPEC, through adjustment of the outputs to maintain the price levels they desire. In a sense, we may say OPEC has pricing power on oil. Suppliers' bargaining power can be understood from following simple industry characteristics. It would be high if 1. The number of suppliers is limited and buyers are many. 2. Suppliers supply some critical inputs to buyers. 3. Competitive intensity in the industry is low with differentiation in products and services. 4. Products/services do not have threat of substitutes. 5. Switching cost for the customers is high. Barriers to entry, threat of new entrants. An industry which does not face the threat of new competitors coming in would be an attractive industry for investors/owners. There could be several barriers to entry for new entrants in a business: licensing, required competence/skills, IT products, capital, oil and gas, distribution reach, banking and finance. Brand loyalty of customers with the existing participants, toothpaste, coffee markets, etc., etc. This is what Warren Buffett calls as the moat. He says, in business, I look for economic castles protected by unbreachable moats. This essentially means he looks for businesses with high entry barriers. Such businesses will have pricing power, viz. can sell the products at a premium without fear of losing customers. Entry barriers in an industry can be understood from following simple industry characteristics. They would be high if 1. There are lots of licensing required in the business. 2. Patents and copyrights prevent new entrants. 3. Huge investments in specialized assets pose a challenge. 4. Strong brands, strong distribution network, specialized execution capabilities, customers' loyalty with existing products/services exist in the business. Based on the above discussion, attractive industry from shareholders' perspective is one that has one or more of the following salient features that create a profitable atmosphere for the business. 1. Low competition. 2. High barriers to entry. 3. Weak suppliers' bargaining power. 4. Weak buyers' bargaining power. 5. Few substitutes. If an industry is having these features, it would have strong pricing power and high profit margins and attract investors. For example, education is an industry in India where there is ample demand and continuously increasing and very little bargaining power of the students, buyers of the service. The industry is by and large protected from recession. Starting an educational institute requires multiple permissions, high entry barriers, and quality institutions are a few, low competition. Teaching staff is hired at salaries decided by the management of the institute, weak suppliers' bargaining power. Competing courses though may be available but do not generate enough confidence amongst students, few substitutes. Thus, education industry can be said to be an example of an attractive industry. Political, economic, socio-cultural, technological, legal, and environmental PESL analysis. PESL analysis stands for political, economic, socio-cultural, technological, legal, and environmental analysis. Some models also extend this to include ethics and demographics, thus modifying the acronym to STEEPLed. This analysis is done more from the perspective of a business which is looking to set up unit offshore and analyzing several countries to choose from. This model primarily analyses the external environmental factors that will act as influencers for a business. To do business in any country, a business must know each of the above factors very well and how changes in any/either of these would impact business. Let us see each one of these individually in brief here. Political factors. Countries can have a variety of political structures. Communist countries would have social objectives above anything else, while capitalist ones would not necessarily have all responsibilities of a welfare state. Further, capitalists also exhibit differences amongst themselves in terms of their approach to the social welfare schemes. Stability in legislation and policy, minimal corruption, bureaucracy, communal tensions and violence coupled with maximum freedom of press. Ease of doing business and quick turnaround time are some of the factors which investors would look at in a country. Healthy public finances and a consistent fiscal policy furthering investment in infrastructure are some other important parameters for investors. Economic factors. The economic parameters of a country such as GDP growth and its contributors, inflation and interest rates, composition of imports and exports, balance of payment and exchange rate stability, stable monetary and fiscal situation, well-developed financial markets, taxation and others, will define its attractiveness as an investment destination. Whether a country depends upon exports or internal consumption, whether this internal consumption is driven by imports or domestic manufacturing, whether the country has high inflation and hence a falling currency, etc., are some of the first questions which an investor will think before investing in any country. Countries' dependence on other countries in terms of important natural resources such as oil, monetary policies of the central banker, balance of payment positions and forex reserves, etc., are very important for an investor to get a comfort level about a country's economic situation. India has seen the worst and the best phases of economies in the last 3 decades. Socio-cultural factors, the social and cultural aspects of the population of the country, such as the demographic profile in terms of age, education and skills, health, social values, lifestyle factors, all affect the choices that people make in what they buy and consume. Cultures affect businesses in multiple ways. With young population in India, India offers different opportunities and challenges in comparison to, say, Japan with aging population. With the change in culture, there is a change in the economic activity as well. For example, given nuclear families and working spouses in metro cities in India, there has been an increase in demand for daycares, facilities, packaged foods, and hotel chains/restaurants. Competitive pressures at the young generation are also resulting in lifestyle diseases such as diabetes, sugar, hypertension, etc. This offers opportunity set for several new businesses in the country. Technological factors. No dimension of life can ever be imagined today without technological support. Technology is playing a crucial role in taking businesses and society to the next level. Development of a scientific temper amongst students leads to an ever technologically evolving society. Countries pushing R&D activities are bound to be at the forefront of technology. Availability of technology-savvy population and institutions driving technology-based initiatives and infrastructure help a country attract investors. Legal factors, legal architecture of the country and ability of legal system to support and protect businesses is what businesses look for in a country. Consistency of legal aspects and no arbitrary changes give comfort to the businesses and investors both. In India, recently the Vodafone retrospective tax case and also the cancellation of telecom licenses and mining licenses, etc., have been examples of discomfort to the investing community. Transparency in the legal environment and enforcement of laws are things which investors would favor. Environmental factors. Developing nations are generally bound to emit environment-harming gases in the atmosphere. A country's awareness of environmental issues and the policies relating to pollution control, waste disposal, mining and protection of natural flora and fauna, rehabilitation of displaced local residents are all thorny issues, which if not clearly spelt out unambiguously can lead to operational and legal issues in the future and ultimately loss of time, money and resource for a business. Investors look for clear policies of government on these issues. As the government pushes for India to become a manufacturing hub, environmental issues are creeping up and these are acting as one of the deterrents for investors ready to enter India. Not all the factors referred to above affect all companies equally. Evaluating the impact of each factor and its criticality for the business is an important step to follow. Boston Consulting Group (BCG) analysis. While models such as Porter's and Pestle are used to analyze the industries and economies, the BCG analysis, developed by the Boston Consulting Group, looks at different segments of a business unit at portfolio basis through the lenses of market growth and cash generation. BCG created a matrix based on sensitivity of growth and cash generation as defined below in pictorial manner. As per the matrix, business segments can be classified as stars. These are segments in a business where market is growing rapidly and company is having a large market share. This segment generates increasing cash for the business with the passage of time. Sarah Sanitaire Ware could be a good example of star with large market share, continuous growth, and significant cash generation. Cash cows. These are segments which require low cash infusion for investment to maintain market shares because of low growth prospects, but at the same time steadily generate cash for the company from the established market share. Navneet Publications, which is into the business of books and notebooks, could be a good example of cash cow. The industry grows at a predictable and steady rate each year. With strong brand name, well-penetrated distribution channel, ready market, and strong balance sheet, all that the company needs to do is change the content every time some syllabus changes and reap the benefits in the form of steady cash flows. Colgate is another example of the cash cow. Question marks. Business segments in a fast-growing market, but having low market share. The right strategies and investments can help the market share of the business grow, but they also run the risk of consuming cash in the process of increasing market share and in the end turning out to be not enough cash generating. Tata Nano can be considered as an example of a question mark which did not succeed, whereas Bajaj Pulsar may be considered as an example of a question mark product which succeeded. Dogs, business segments which have slow growth rates and intensive competitive dynamics which lead to low generation of cash are categorized as dogs. BCG Matrix provides interesting sense of the businesses/segments in terms of their attractiveness for the investors. Structure Conduct Performance SCP Analysis. Another method of analyzing industries is to look at the industry structure, monopoly, oligopoly, its conduct, commoditized or specialized, seasonal or round the year, cyclical or non-cyclical, etc., and finally its performance. ROE, ROIC, WACC, etc. Structure, Conduct, Performance, SCP Analysis approaches the industry evaluation exactly with this categorization. SCP analysis may be seen as extension of Porter's model where probably first 2 points structure and conduct were captured. Under SCP model, one also goes into the financial dimension of industry from analysis perspective. Basic elements of SCP analysis are captured below in brief. Structure analysis. Industry structure refers to the competitive intensity in the industry, number of players, concentration of business in industry, relationship among the various players, market size, its growth rate, etc. In this section, analysts study how many players exist in the industry. Is there domination of few players in the industry? How is business scattered between organized and unorganized players? Are there any threats from substitute products? How are equations between suppliers and buyers, and is there backward/forward integration already in existence or a possibility in future? Thus, very broadly coverage of analysts in this section overlaps with what we study as part of Porter's 5 forces model and the SWOT analysis model. Conduct analysis. The structure of the industry as described above will define the conduct of the businesses on aspects such as pricing and product innovation. Each industry will have its peculiar behavior. Umbrellas and raincoats would be seasonal businesses and FMCG and pharma would be round-the-year ones. High interest rates may deter people from purchasing real estate and four-wheelers, but two-wheelers may not be impacted that much. Mining business may be commoditized, but FMCG and white goods may be sold purely based on power of brands. So, while looking for an industry's conduct, analysts have to study several factors such as: is business cyclical in nature? If business is cyclical, what are the factors affecting the business, commodity prices, interest rates, currency prices, or some other global factors? Is it a highly specialized business which requires skilled labor, or it is a low-skill-based industry? For skilled-based business, is there enough talent available? How customers choose the products/services? How will technological changes affect this business? Is business heavily dependent on government policies? Performance analysis based on structure and conduct of the industry would generate financials for the investors/owners. Businesses with high return on capital/equity are the ones which create wealth for shareholders/owners in the long run. While analyzing performance of an industry, analysts will look at several numerical ratios which are dealt with in great detail in the unit on quantitative analysis. Key industry drivers and industry KPIs. When studying an industry to identify trends or while preparing an industry landscape, it is always important to focus on the key performance indicator, KPIs, for the industries. The key performance indicator varies industry to industry, and a metric that is suitable to analyze one industry may not be suitable for other industries. For example, a metric such as revenue per employee is likely to be very useful in analyzing a service provider such as a BPO, as the industry is labor-driven and their billing is generally based on the head count assigned on a contract. However, the same metric is far less valuable for manufacturing industries, which are capital-intensive. Most often, analysts are guided by the companies in the industry in terms of identifying the KPIs. Reading annual report and the management discussions of a company can certainly help analysts understand what the industry players consider as KPIs for the relevant firms. In addition, an analyst can be guided by two other factors: 1. Unit of pricing, and 2. Key constraining factors. Unit of pricing. Unit of pricing essentially refers to what a company considers as unit while pricing a product. It is far simpler in the case of manufacturing industries, as the unit of pricing is the number of goods sold. However, it can be very challenging in the case of service sector. For instance, in the case of a cafe like Starbucks, it may appear that the unit of pricing is the quantity of beverage sold. However, in substance, their pricing is more likely to be driven by the consideration of how much they expect to earn from one patron rather than based on quantity of beverage sold. Key constraining factors. Another important factor to consider while deciding on the KPIs is the key constraining factors for the industry. At times, these constraints may vary within an industry. Further, these constraints may also gradually change over a period of time as the industry evolves. Broadly speaking, the constraints can be broken into three categories. 1. Demand-side constraints. 2. Supply-side constraints. 3. Regulatory constraints. Since a company's performance is dependent on how it handles these constraints, analysts should look at KPIs that reflect these constraints. For example, if an industry has limited market size, driven by limitations in number of target customers, then industry penetration rate will be a key factor to look at. On the other hand, if an industry is constrained by capacity constraints, then capacity utilization rate will be an important metric to track. If regulatory constraints exist, then it might be prudent to track metrics followed by regulators. KPIs for select industries. Airlines and other transportation and logistics. In this sector, the pricing is driven by quantity of passengers/cargo carried and the distance it is carried. In terms of constraints, their ability to provide service significantly depend on the amount of capacity they hold. Accordingly, some of the important KPIs for the industry include 1. Passenger/cargo kilometer, km, 2. Price per passenger/cargo km, 3. Capacity and utilization rate/occupancy rate. Passenger/cargo km is a bundled metric that is arrived by multiplying the number of passengers or quantity of cargo with the amount of distance traveled. Automobiles and capital goods. In this sector, the unit of pricing is typically the quantity of goods sold, and one of the key internal constraining factors for sales is their capacity. Accordingly, the critical metric for the industry includes 1. Volume and volume growth, 2. Average realizations and their growth, 3. Capacity and capacity utilization rate. Commercial bank and NBFC. For the banks, the unit of pricing is the value of loan and the price is denoted as interest rates. Lending money and recovering the same back with a healthy interest rate that is well above its cost of funds is an important KPI. In terms of constraints, their ability to lend depends on the amount of deposits and the amount of the regulatory capital they hold and the mandated liquid assets they need to hold. On the external front, the business is affected by the overall flow of liquidity in the market. Accordingly, the following are some of the key metrics for the industry. 1. Net interest margin. 2. Capital adequacy ratios. 3. NPA ratio. 4. Growth rates in deposits and loans. 5. Cash reserve ratio and statutory liquidity reserve ratio. 6. CASA ratio. Since the cost of funding for banks depend heavily on central bank policy rates, it is also extremely important to track that. Consumer goods. In the case of consumer goods including consumer staples and consumer discretionary, the unit of pricing is generally the quantity of goods sold. Accordingly, the key metrics tracked for this industry include 1. Volume and its growth, and 2. Average price and its growth. In consumer durables, capacity can become constrained especially during the period of high growth. Hence, it may be appropriate to track capacity and utilization rate as well. IT services/BPO/KPO. In this sector, the pricing is typically based on the number of headcounts who are assigned per project per month, often referred as full-time equivalent or FTE per month. Since it is a labor-driven industry, one of their key constraints is the availability of workforce. Although labor force for the sector is available in abundance in India during period of high growth, it can become a constraint. Further, since the sector is largely export-oriented, their realizations are heavily impacted by the foreign currency fluctuation. Further, some of the companies in the industry are heavily reliant on a handful of customers, which one hand gives a steady stream of revenue while on the other creates high customer concentration ratio. Thus, some of the important metrics to track in this sector include 1. Average number of FTEs billed, 2. Average revenue per FTE, 3. Bench strength, spare capacity, and attrition rates, 4. Constant currency growth rates, 5. Customer concentration ratio and number of million-dollar customers, i.e., customers who are billed more than $1 million per annum. Media. The media industry includes 1. Print medium, 2. Television and radio, and 3. Online medium. Revenue for the media industry comes from two sources. 1. Payments by users, and 2. Advertisement revenue. Having said that, majority of their revenue is earned through advertisement. In print media, the unit of pricing is based on the amount of real estate space occupied in the paper, while in television and radio, the unit of pricing is the amount of airtime of the advertisement. Since there is real limitation in terms of the amount of airtime or real estate space that can be allocated to advertisement, their ability to grow largely depends on attracting larger audience so that they can charge higher price from the advertisers. This, in turn, depends on their ability to acquire good quality content at reasonable price. In online media, the unit of pricing is directly based on the number of views/clicks per advertisement. Thus, the following are some of the important metrics to track. 1. Readership/viewership, TRPs/number of site visitors. 2. Average ad realization per unit. 3. Content acquisition cost. Retail. Organized retailers sell variety of products. Each of these individual products will have different units of pricing. Further, since the business is trading in nature, they can quickly shift the products they retail based on market demands. Therefore, the unit of pricing is far less relevant. However, in terms of constraints, their business growth heavily depends on expanding their store network in localities where they can generate healthy sales. Factoring these aspects, some of the key metrics tracked in the industry include 1. Number of stores, and 2. Same-store sales growth. Telecommunications/internet service providers. In India, till a few years ago, telecommunication providers charged customers based on the number of calls, messages, and data that were used. Over the past few years, this model has eventually changed, and more subscribers are getting charged a fixed monthly rental. However, regardless of the billing model, from an analytical perspective, a subscriber is considered as the unit of pricing, and companies try to increase their subscriber base while trying to upsell their services to existing subscribers. In terms of constraints, the biggest constraint for the industry is the limited market size, as the number of subscribers is limited by the population in the geography they serve. At individual service provider level, they also must ensure that they win over competition to acquire and retain a customer. Analysts, therefore, prefer to track the following metrics. 1. Average revenue per user, ARPU. 2. Subscriber churn rate. 3. Cost of subscriber acquisition. 4. Market share. Regulatory environment/framework. Industry analysis cannot be complete without adequate knowledge of the rules of the game. Even small changes in regulatory framework can have big impact on the businesses. For example, the whole discussion in India on FDI and multi-brand retail has been revolving around how much should retailers invest in developing the back-end infrastructure, what could be construed as back-end infrastructure, could they buy out some firm's existing setup, how much minimum they should purchase from Indian vendors, etc. Changes in the environment policies have resulted in closure of various mines and have affected the businesses drastically. Cancellation of telecom licenses has affected the business in that industry. The latest amendments made to the Companies Act have changed the entire landscape for doing business in India. Therefore, analysts should pay enough attention to the regulatory aspects of businesses. Taxation. Taxes are tools that a government uses to earn income which can be used to meet its expenses. However, governments also use taxes as a tool to encourage or discourage certain businesses. For example, the state government of Kerala introduced a VAT tax in 2017. They levied 14.5% additional tax on junk foods. This was done with the intention to discourage the junk food industry. Similarly, at a national level, India has several slabs of goods and service tax, GST. Many essential products have no GST or have lower GST rate, while luxury products have much higher GST rate. Broadly, taxes charged by government can be classified into two categories. 1. Direct taxes. 2. Indirect taxes. Direct taxes. Direct taxes refer to taxes where the incidence of the tax and liability for the tax are on the same person. In other words, the person who has to bear the tax is also the one who is obliged to pay the tax to the government. The most common form of direct tax is the income tax. Every individual and business has to pay a particular rate of tax on the profits they earn. Tax laws prescribe how and when income and expenses should be recognized. Although most often these are driven by nature of income and expense, in many cases these are also driven by considerations on the business practice that government wants to encourage or discourage. For instance, in India, in order to promote research and development, companies are allowed to claim expense that is 1.5 times of actual expenditure incurred on certain scientific research activity. On the other hand, in order to discourage delay in payment of interest owed to scheduled commercial banks, companies are allowed to deduct it as expense only if they actually pay it. These adjustments often result in difference between the profits shown for external reporting purpose and for tax purpose. Since government use direct tax also as a tool for promoting or discouraging certain activities, tracking the developments is very critical to understand their impact on the industry's growth. Corporate income taxes in India have 4 components: 1. Income tax, 2. MAT, 3. Surcharge, and 4. Cess. Income tax. Indian companies are required to pay 30%, 25% in case total turnover was below 400 rupees crores in a financial year of their taxable profit as income tax to the government. However, the Act allows companies to choose alternative schemes of taxation under which they can pay a reduced tax rate if they forego certain benefits in terms of expense deduction. Available in the Income Tax Act. Such rates vary from 15% to 25% depending upon when the company was established and what scheme they opt. Minimum alternate tax, MT. If the income tax payable by the company on its profits is less than 18.5% of the book profits, then the company will have to pay 18.5% of book profits to the government. However, any excess tax paid in such form can be availed as MAT credit to set off future tax obligation to the extent it exceeds MAT in the relevant year. Surcharge. Surcharge is a tax on tax. In terms of income tax, the central government shares the revenue with the state governments in which the companies are located. However, in terms of surcharge, the entire tax revenue goes to the central government funds and it is not shared with the state governments. These are charged at a rate on the income tax/MAT paid and may be altered every year. For assessment year 2020 to 21, which pertains to financial year 2019 to 20, the rate of surcharge is 12% of taxes payable if the profit is above 10 rupees crores. The same will be levied at 7% if the profit is between 1 rupee crore to 10 rupees crores and nil if profits are below 1 rupee crore. Cess. It is an additional levy that is charged on the taxes plus surcharge. Cess is meant to be used for specific purpose for which it is levied. For example, an education cess can only be used by the government towards education-related expenditure. For assessment year 2020 to 21, the government levies a total cess of 4% that is meant for health and education. Indirect taxes. Indirect taxes are those taxes where the person bearing the tax is different from the person liable to collect such tax and transfer to the government. Goods and service tax, GST, is one example of an indirect tax. The tax is levied on the seller of the goods. However, the seller collects the money from the customer and deposits it into the account of the government. Therefore, it is the end consumer who bears the tax. India has various indirect taxes. However, in order to combine these taxes, government brought in GST and removed other taxes. However, some products, fossil fuels and liquor and activities, imports, are still covered under the old system. Goods and service tax. Goods and service tax is a tax that is charged at the time of sale of goods or services. These are calculated as a percentage of the invoice value and sellers charge this to the customer. Sellers then remit this amount to the government. In order to avoid double taxation, sellers are allowed tax credit, i.e. deduct the GST they paid to their suppliers and they only have to remit the balance to the government. Most goods and services are charged GST at 18%. However, the GST rates vary from 0% to 28% for different categories of goods and services. Excise duty. Excise duty is tax on production. With the introduction of GST, excise duty has been removed for most of the goods. However, excise duty is still applied on liquor, petrol, and diesel as these products do not come under GST. Value-added tax, VAT. Value-added tax is levied on sale of products. These are charged by the state governments. Similar to excise duty, these taxes are currently applicable only for liquor, petrol, and diesel. Customs duty. Customs duty is a tax that is levied on imported products. The rate of customs duty varies based on the product that is imported. Other taxes. Road tax. Road tax is paid by the purchasers of new automobiles. These are lifetime taxes paid up front. This tax increases the acquisition cost of automobiles and thus impacts automobile sales and in turn other downstream industries such as auto ancillaries and general insurance firms offering vehicle insurance, etc. Stamp duty. Stamp duty is payable whenever any document needs to be registered. These are largely required at the time of purchase or sale of asset. Since this is an upfront cost, it increases the cost of acquisition of asset for the buyer or realizable value of assets for the seller. Change in stamp duty affects the real estate industry and investment management firms including stockbroking firms and asset management companies. Security transaction tax, STT. Security transaction tax is paid at the time of sale of securities. Since it reduces the realizable value of security sales, it discourages short-term trading. Thus, this affects stock traders and in turn stockbroking firms. Sources of information for industry analysis. There are several sources of information on industry. Some of them are stated below. Industry reports from various sources, industry journals and media reports. Annual reports of companies in the industry, management discussion and analysis section. Associations/trade bodies publications. Relevant ministry website/publications.